Welcome back, Yield Nerds, episode 110. The weeks are flying by, and since we are getting close to tax season, I thought I would introduce TaxNerd meets Yield Nerd. So let's learn more about it. I'm going to share what I learned when I prepared taxes. Yes, people, I am done with my taxes. Well, we're at 267 something subscribers. Thank you for your support. If you're joining for the first time, please use the playlist that organizes the show from the very beginning, assuming you have little to no knowledge in fixed income, which is where I was 3 years ago, and brings you up to this one. And most importantly, folks, I do not have any magical powers of prediction. I have opinions, and I'm often wrong. So make sure you check anything here on your own. Well, the agenda for today is in three parts. One is I'm going to share what I learned, the aha moment, so to speak, when I did my taxes. And there is tax nerd. She's sweeping my money into a bucket and she's got the scissors to chop it all up. And I'm trying desperately to stop her. Probably not the best idea to stick my finger into the scissors, but Dolly, you got to work with me here. I will also share my strategies for 2024 and what I'm going to do the next 60 days. So, having said that, please remember this is not investment advice or tax advice. I'm not a wealth management advisor. I don't have snake oil. Use your own judgment. Well, what did I learn when I filed my taxes? There were four aha moments. And the first is state tax free. And this is something that I have covered before, specifically in episode 73. I have posted a link to episode 73 right there. Please check that. And that is how you can check and make sure that your interest from treasuries are indeed state tax free. And so that's the first thing I did. I used a certain tax software. We don't do product placements here. So I used a certain tax software and then I went back and checked and said, okay, it got it right because I got to make sure all the hard work I did buying treasuries did save me on state tax. So watch episode 73 if you have not to double check. Second thing is the concept of accrued bond discount. What is accrued bond discount? Well, if you go to your last year's tax filings, assuming you owned any treasuries last year or any fixed income last year, you can go to the Schedule B, and in Part 1 under interest, you may see the infamous word accrued market discount. And then you're like, whoa, what is that? Because it increases your taxable income. Here is an example. This was my 2023 tax extract. So as you can see, in the year 2022, I bought a certain fixed income security and I paid $5,732 for it. And I bought $100 par value at $95.49. So that is the discount. And oh, by the way, it matured about a year and a half from the date I bought it. And when it matured, the 5,700 something became 6,000. How cool is that? And oh, by the way, along the way, it paid 0.7% in coupons. Is that a good deal? Is that not a good deal? It's very hard to read this and even understand what the yield to maturity is. That is why I turn to yield to maturity calculators. And this says if I buy something that is 95.49, it matures for 100 in about a year and a half, and you have to calculate exactly the number of days from the settlement date to the maturity date and divide that by 365 to get that number. And if it is the annual coupon rate, which is paid twice a year, drum roll, you get 5.393% yield to maturity. And about a year ago, that was a pretty good deal. Well, it's actually 2 years ago because I bought this in July 2022, and 5.4% at that time was excellent because the market was at 3 or 4 or whatever percent it was. And I was doing my yield Super Bowl and said, that's what I'm going to buy. And so that is the accrued market discount. And here's how it's accounted. It says, hey, Badri, remember you paid 5,729 for something that became 6,000? Well, that money is not free. That is income you earned. So I'm going to dock you for taxes for that at your effective tax rate. That is what the Schwab tax statement is saying. And this gets put into my tax software, and $270 from this one security got added to my income. And that is how accrued market discount works. So remember, accrued market discount increases your taxable income. Well, in this case, 270 something dollars. All right, that scissor is starting to pinch me. I'm paying extra for accrued market discount. What in the world is the amortized bond premium? All right, now we get to talk about the exciting part, the amortized bond premium. My motivation to start Yield Nerd, true story. Well, let me tell you what this is all about. In your 1020, 1040, if you were to go back to last year's filing and take a close look, Schedule B, Part 1, you may see a line that says ABP adjustment. And you say, whoa, that's the amortized bond premium. That means you, like me, bought some bonds at a premium. Smart move. Well, let me explain a little bit more. And so here is an actual example. Yes, I was the genius who bought this under the advice of somebody. And I bought this in August 2020 at the depths of COVID. I didn't know what I was doing. I took advice from geniuses who told me that, hey, you know what, look at what you can make in 3 years. The federal funds rate is a 0.25%, and this is the right move. You will get $12,000 back when the bond matures in 3 years. And yeah, you have to pay a little bit of a premium, 1,229 now, but come on, that's nothing. You know why? If you look at it on an adjusted cost basis, let me explain what I mean by that. Uncle Sam gives you back the tax offset. So the 1,229 you paid, every year Uncle Sam keeps giving you a little bit, and you literally make that back. So don't be shy about paying a bond premium, Padre. You can do this. So all you do is you pay 12,000 plus the bond premium now, which is August 2020. And this is Microsoft. They are not going to go under. Amazing company. Plus they pay 3.625% interest. Do you see what you're doing? Instead of making a 0.25%, you could be making 3.625%. This is a no-brainer. Badri, you should do it. Trust me, I'm a genius. And that is what I was told. And I'm like, wait, am I leaving money on the table here? Oh, wait. Uncle Sam is giving it back in tidbits, and the federal funds rate is a 0.25%. This is 3.625. How could I go wrong? Well, looks like we should all buy at a premium. And I started jotting down my notes. And I said, wait, if Microsoft had indeed called that bond, if they had indeed called that bond, I would have lost 1229 one day later, which is a loss of 12% on that $12,000 I paid, or 10%. And next, I paid the 1229 in premium on August 2020, and I allegedly got it back in bits and pieces over the next 3 years. There is some loss in the time value of money. And the big thing, the aha moment for me was what I really got was a taxable income offset, not a tax credit. Let me explain that in detail. So here is the bond I bought, 3.625%, and I paid 12,000 plus 1,229. And if you were to split it up, and I'm going to take a hypothetical human who made $50,000, they paid effective tax of 20%, their net income was 40,000. When you take 12,000 from the bank of that person plus the 1,229, that is after tax money you're taking out. That really is like 15,874 of gross income. So you tell them, hey, take 15,874 of gross income, which is really 13,229 of net income for you. Take that, give it to me. And look, I mean, you're really only buying 12,000 of bonds. Yeah, look the other way. That's okay. And at 3.625%, you're going to get interest of 435 a year. So here you go, 435, 435, 435. Yes, you have to pay taxes on interest, but hey, everybody has to pay taxes. But come on. Not only that, look at this adjusted bond premium. How beautiful. And I'm using round numbers here. It doesn't matter. You would get 300 in year one, 400 in year two, 500 in year three. You add that together, you kind of sort of make out that $1,200 that you paid extra. So you get your money back. And do I? And that is when I started doing my homework. Well, the $300 is reducing my taxable income, not reducing my taxes. So at a 20% effective tax rate, assuming my tax rate was 20% every year thereafter, at best, my actual taxes dropped by 60 bucks, 80 bucks, and 100 bucks on those 3 years. So let me summarize the deal. You gave me back the 12,000 at the end of 3 years. I'm going to give you 15,874 of my gross income, which became 12,000 of my net income. You're going to give me tax credits of 240 and that 435 over 3 years and over call risk as well. And I got back 12,000 of my net income after that. I'm a genius, and that, my friends, is the reason why I appreciate my own education through Yield Nerd, and I hope you do too. So here are my actual proceeds, just so you know, this is how the cookie crumbled. I transferred this from a certain other online broker and wealth management advisor that shall go unnamed. And here is the transfer coming into Schwab. And the 12,000 came in. Here is my 217 and a half times 2, 435. And when it matured, I got the 12,000 back, and I sit there and I twiddle my thumbs and decided, maybe that was not a good idea. So here's my learning. I still would buy long-term corporate bonds. I'm not opposed to it as long as there is a big premium over T-bills and the yield to maturity works out and the company cannot call the bond and it's financially stable. And I say, wait a second, why would a financially stable company want to issue a bond that is significantly higher than the T-bills and sells only at a small enough premium? The mistake I made, it's not anybody else's mistake. I should do my own due diligence. The mistake I made is not do the cash flow. So given today's interest rates, premium corporate bonds are not my cup of tea, but you do you. Let me go to the next one and say, well, what about muni bonds? Maybe I should buy those at a premium because remember, they are tax-free. Ooh. So let me dive deeper. And this is yesterday's rates. I went into the 5-year, which is 3.94 interest-free at the federal level. And when I click on it, I see that the coupon is 5%, stunning tax-free coupon at 5%. I need you to keep your focus right here because I'm only going to convert this 5% into your marginal rate. I don't want you to focus on your effective tax rate. I'm going to argue that is like making 7%. Hey, don't look at the fact that these are trading at a premium. Focus. And so you could make 7%, give it to me. And then now that I'm a yield nerd, I started looking a little bit deeper. The actual yield to maturity, because you're paying a premium, is more like 4.4%. And if my effective tax rate is 20%, the 4.4% is more like 5.2% pre-tax for 5 years. And you sit there and go, well, 5.25 for 5 years looks reasonably good. And I sit there and go, well, what about the adjusted bond premium? Do I get that back? Well, turns out the accumulated bond premium does not apply to muni bonds, which means the $1.50 or $1.70 premium that you paid for every $100 never comes back to you. So good luck crossing that chasm, my friends. So here is my learning. If you give me a 5.25% pre-tax yield for 5 years on a non-callable bond, I suppose I would look at it as interest rates drop, especially, if I have tax advantages, that may be good. But before I did that, I checked agency bonds and agency bonds pay 6.15% before I even apply the state tax credit. In Illinois, with an 8% state tax, that is more like 6.64%. Yeah, it's hard for me to go buy muni bonds right now, especially if the yield to maturity is 4.37% before I add the tax credit. So, nice try, but Yield Nerd is not going to do it. And one more thing, if your bulk of your income is coming from investments, there is something else you may need to be aware of. It's called the net investment income tax, and there are certain limits. And if you cross those thresholds, Uncle Sam eats another 3.8% of your income as, hey, you're investing too much, I get to bite that apple as well. Something for you to be aware of. May or may not change your behavior, just be aware of it. So what does that mean for me and my strategy for 2024? Well, I am going to start making a couple of changes. I'm actually going to decrease my estimated state tax payments because last year worked out very well for me. My state tax was a record low because the bulk of my income was in T-bills. And I do plan to go back to look at those munis. I'll take a look at them if they are the right yield to maturity. and they are not callable, I'll buy them. And the only thing is April 30th, I'm afraid of that date. And so I'm going to sit there and wait. I do have two ETFs that are burdens for me. They are trading at a loss for me. I'm not inclined to sell them right away, but they do offer really high yield and offer ordinary income with no tax benefits. And so I'm going to sit on them, but I will get out of them as well. But my big date right now is April 30th. So what am I going to do the next 60 days? Yield Nerd is leaving town in terms of equity investments. I sold practically all my equity that was above cost basis, and most of it is on 60-day treasuries, and I've left equity town. And because I invested with reasonably good filters, everything I sold at a profit. I barely have 4 something percent of fixed income, and most of that fixed income matures within the next 60 days. And so my thesis is the red team and the blue team in Washington, D.C., the odds of them collaborating are very, very low. Shutdown aversion is very, very low. Spending cuts on April 30th are very, very low. The government is the biggest customer. And if the biggest customer suddenly has less money in their pocket because they cannot spend, my call is that we're going to have some turmoil after April 30th. You do the math. This yield nerd is signing off of equity investing. I'm going to be short term and I'm going to chill and watch what happens. That is my wonderful opinion of equity investing moving forward. Thank you. You do you. Thank you for watching Yield Nerd.